Welcome to the latest episode of Quest for Twice. In this episode, I'm going to discuss my growth portfolio. So far, my investment success has come from investing in value stocks. For example, Adcore and Energy Transfer are both considered stocks in the value sectors, the industrial sector as well as the energy sector. However, growth stocks consist of a very big portion of overall stock market. To have durable, sustainable investment success, it's important for me to understand how to invest in the growth sector. So I started building positions in the past summer, from June to as recent as September. So now it becomes about 1/8 of my overall portfolio. So the capital I invested were put into 4 stocks: Amazon, InMode, Poshmark, as well as Boston Beer, which has a ticker of SAM. So let me go over those stocks briefly. So InMode is a very small company based in Israel. It sells aesthetic devices using radio frequency energy to make people look better, for example, by tightening skin and reducing fat. It sales compounded annual growth rate was 57%, so it's a very high rate, and with a gross margin of 85%. Its a price over gross earning ratio was about 24. So it tells me that it's highly valued by investors. And I think it has a narrow moat because it has a better technology than its competitors. Its RF technology is based on bipolar, and comparing to competitors using the monopolar technology. I'm not going to the details why bipolar is better, but because of its bipolar technology and associated pattern, I believe it has a narrow moat. And I think the moat has a trend to become wider because it's fast growth and taking up the market share. And with that, it's going to have more of a brand recognition, as well as a switching cost, because once a surgeon or a physician adopted its equipment, then there is a sunk cost, and it become harder for them to switch to its competitors. Another small growth company I invested in is Poshmark. It's a platform for second-hand clothing and other accessories for people to buy and sell. Its car was about 28% with a gross margin of 84%. The price over gross earning ratio is about 9, and tells me that the investors are not so hot on this stock. I don't think it has any moat at this point because it's so small. However, if it can keep its growth rate, then it'll attract more buyers and sellers to its platform. With the network effect and the brand recognition, it'll establish moat. Another company I invested in is Amazon, which people are usually very familiar with. It has a similar growth rate as Poshmark, but it's just much bigger with a much lower gross margin. The price over the gross earning ratio is about 15. And I believe its moat is very wide given how established it is. And on the other hand, since it's so well established, its moat trend is stable. The last company I invested in is Boston Beer. Boston Beer makes both beer and hard seltzer. Its 10-year growth rate was about 12%, with a gross margin of 46 to 52%. Currently, it has a price over gross earning of 6.6. It's the lowest among the group because of the recent significant price decline. I believe that's due to the investor very negative sentiment about its growth prospect. It has a narrow moat because of its large scale in the craft beer industry. It's actually the second largest craft beer manufacturer. And also it has a brand because of it's a large marketing and sales investment it made in the last 10 years. And I think its moat is stable. So if I look at the capital I invested, so Amazon and InMode takes about 30% each, with Boston Beer and Poshmark each takes about 20%. The reason I invested more in Amazon and InMode was because of higher conviction I have in those stocks, and given the narrow moat InMode has and a very fast growth rate, and a very wide moat for Amazon and a modest growth rate. So what are my performances and learnings so far related to the growth portfolio? So far, my aggregate return is about 4% compared to 5% for S&P 500 over the same time frame. So despite the similar performance, if we look into the details, actually some observations can be made. First one is that those four stocks had a very different returns. It's a very large variation. So keep in mind that since I don't leverage, the lower limit of a return is a negative 100%. The stock price goes to zero and becomes worthless. However, the upper limit is infinity in practice. Of course, the price will not go to infinity, but if it becomes 100,000%, then it's a really large number. So in practical term, it's like a infinite number. I.e., the return is a variable. I consider it as a log normal distribution. So for InMode, I made first purchase in mid-July, and so far the return is about 40%. What happened? So since InMode has been delivering, it had reported the latest earning result. It had a similar growth rate as before, and just investors like it more compared to when I first made my purchase. On the other hand, Poshmark, I made the first purchase at the beginning of August. And now the return is about negative 40%. Why? Because in the latest earning report, the management gave disappointing guidance, implies that the growth rate would decline for the rest of the year. It's a similar story for Amazon. It had a 4% return so far, but it's mostly driven by the disappointing guidance given in the latest quarterly report. And for Boston Beer, I only purchased the stock about 3 weeks ago, and the return so far is negative 7%. That's also related to the disappointing guidance it gave in the last quarterly report, as well as a downward revision just given last week. So at the current price to gross earning ratio, the InMode went up compared to the point when I bought it, and the Poshmark came down. So how do I value those stocks, given that they have all different growth rates? So if I use an analogy of PEG, so that's a price earning ratio over growth rate, then I can get the numbers I tabulated on this slide. However, is PEG the right ratio to use? Actually, I don't think so. In the next episode, I'm going to the details of a tool I came up with to screen the valuation of growth companies. So my learnings so far include first one is the short-term returns are driven by investor sentiment. For InMode, its growth story was unchanged before and after the earning report, but the stock price went up by 40%, and that's because investor sentiment turned positive. Similarly, Poshmark, the investor sentiment turned negative, mostly because of the disappointing earning guidance. However, if we focus on long-term the stock price performance, it will really be driven by the long-term business performance. However, it's difficult to predict the future. As a result, I can say that the long-term return of an individual stock is very uncertain. So what's my strategy to invest in the growth sector? So I'm going to diversify given the large variations and uncertainty related to an individual stock return in the long term. I will consider valuation and look for moat. My belief is that one winner will likely dominate all losers. For example, InMode, if it keep growing, if we look at the pie chart, now it's about 40% of my growth portfolio compared to 31% of the capital I invested in. And Amazon stayed steady, and Boston Beer and Poshmark had shrunk. So if I diversify, then it will be more likely that I will find that dominant return given by a very successful business. And the related observation is that I will not do a rebalancing because that means I will sell my successful business and buy the business with the disappointing business results. So how do I know that a winner will keep on winning? So I believe the key is to understand the moat, because the moat will help the business beat the competitors and keep growing. And when for a small company, when it grows bigger, the moat actually will become wider and cement its leading position among its competitors until it reach a mature point that it just takes so much market share that unless the overall market grow, it's going to have the same growth rate as the overall market. But for small companies like Emode and Poshmark, that's a far away a point. And for Boston Beer, it's less mature compared to Amazon. So those are my learnings so far. Until next time, happy investing.